Now, more people working from home plus low interest rates has made the U.S. housing market a very competitive place right now. In 2021, home prices grew at a record pace, surging to a 15-year high. If you put your house on the market last year, you were almost guaranteed to get multiple offers. The National Association of Realtors says a total of 6.1 million homes were sold.
And home sales are falling off now. If you look at Greenwich, Connecticut, for instance, sales fell 36%. But that's because there are precious few listings on the market. So what's to come? Jonathan Miller is president and CEO of Miller Samuel Real Estate Appraisers and Consultants, and he joins us now with more. Jonathan, great to speak with you. We've got extremes in both supply and demand. I want to hit on the supply part first. There's just not enough of it. Why is supply so low right now? Because even in previous housing booms, it never got to this point. People who wanted to buy a house were selling their house first. What's different this time?
So I think what's different is that despite, if you think about the 30-year fixed mortgage was about 5% back in 2018, and during the pandemic, it fell to almost half that, and it's up a little bit from there. So I don't think people are giving enough credit to the power of demand that has been thrown on the housing market in the middle of, a relatively robust period that we've had, aside from the quarter during the initial moments of the pandemic and prior to the pandemic. So it's burned off supply much faster than being created. And most of the new construction, new development that's being built is skewed towards the upper half of the market. So it doesn't solve the problem, and is only maybe 10 to 15% of the national picture and inventory. Most of the inventory is existing properties.
Well, should we be thinking of this as a pandemic-specific problem, or is it bigger than that? Is it going to be more long-lasting?
So I think, part of this was initially the pandemic, but I really look at the pandemic as the catalyst to remote work and the essentially the relationship between work and home, and that's all being recalculated right now. And so we're seeing that in housing behavior around the country, where there are people that can live farther away from the office than they used to be able to, and that's set certain housing markets on fire. Poor probably use of terms, but really, the demand, they haven't seen certain markets that are further away from cities are booming and they don't have traditionally the supply. One important point about inventory is, think of inventory, existing inventory. 85% of houses out there is this living, breathing organism based on people's life cycles. And you throw incredibly low rates at it for a sustained period of time, it can't replenish fast enough. And so now we don't just have low inventory, we have unbelievably low, historic low by a long shot. And that is creating havoc in the housing market.
Okay, but you mentioned low interest rates. Interest rates are set to rise perhaps later this year. I wonder whether that will have any material impact on what we're seeing in housing, when so many of the buyers are all cash buyers, and therefore it doesn't matter whether interest rates are high or low, or they're institutional investors and they have the means to be able to finance whatever they're buying.
Yeah, and also if you have another COVID variant, that'll temper rate growth as well. So there's a lot of uncertainty in that regard. I think the way I would think of it is that rates are so low that even if they come up, there's concern about some sort of correction, or even some talk about a bubble. We have the tightest credit conditions we've had in relative to the housing bubble. This is not a lax lending environment, and even if inventory doubles, it's still low. So yes, we'll expect inventory to rise as sales level off, but I think that over the next couple of years, on the other side of this boom, I think we're going to be using the words like plateau or moving sideways as opposed to correction, simply because there isn't a surplus of inventory. Leading into the housing bubble, there was a tremendous surge in inventory, but sales activity was growing faster, so the market felt really fast. We're not seeing that this time.
Okay, so I've got to get your personal advice, Jonathan. I'm under 30. I've always dreamed of having some type of property ownership by the time I turn 30. It feels like that's getting increasingly less likely. Should I just accept that the millennial generation is going to become the generation of renters forever?
Absolutely not. To get personal, I have four sons. The three oldest are all millennials, and they've all bought or are buying houses right now
Jonathan,
or
they
in the
have
last year
you.
or two.
Come on.
Yeah, I don't know if that's a benefit or not, but the way to think of this is that you shouldn't use the growth in housing prices as a barometer of sort of an inflationary barometer. You should look at mortgage payments. And mortgage payments, in terms of principal and interest portion of monthly housing costs is not the whole thing. So the rate of growth is much lower. It's still high, but it's much lower than what we're seeing for prices themselves.
But Maddie brings up a good point, and that is housing unaffordability. It feels like it's already kind of extreme. How much more extreme is housing unaffordability going to be before, I don't know, policymakers start looking into it and actually doing something about it?
So I think that we're in a pretty strong, I don't see any relief in terms of inventory coming back unless rates really go up. We start talking about in the 5% range, which is, I think, where they should be. There's a tremendous distortion caused by very low rates. But the reality is that the leverage in terms of how much debt people have relative to household income now is far less relative to household income than it was during the bubble itself. So again, housing prices are not the metric to use in terms of affordability. It's the payment itself.
How does the rental market compare here? What's leading and lagging? I've noticed anecdotally in New York that you can get a lot more from a monthly mortgage payment, for example, than a monthly rent payment. The difference is really staggering there.
Yeah, so when you think of the rental market, first of all, in Manhattan and many large cities, because the economic damage from the lockdown and COVID was much more punishing to lower wage earners than higher wage earners, what we're really seeing is a rental market that's highly polarized. So in Manhattan, if you compare the upper half of the market versus the lower half by price, the upper half rents are up about, on a year-over-year basis, they're up 30%. But if we compare them against 2 years ago, they're up about 8%, which is ahead of sort of pre-pandemic conditions. If you look at the lower half of the market, rents are up about 11% year over year, but they're down 7%, meaning they're 7% below pre-pandemic. So it's a highly polarized market, and a lot of these stories about the market, about 80 people waiting in line for one apartment or bidding wars, tend to be skewed towards the higher end because that economic cohort was less savage by the pandemic.
Wow. Well said. We like talking to you because you're an appraiser, which means that you offer an unbiased opinion on a home's value, and you're looking at the data and looking at the value of the data and how it's changed over time, as opposed to someone who makes money off of just a sale of a property. So I'm curious if you could walk us through how the drop off in home sales and home purchases because of the low inventory affects the pricing of homes. Because if there aren't enough transactions taking place, there aren't enough comparisons. And we know that sellers use comps when they want to price their homes to put on the market. And we know that buyers use comps when they decide how much to bid for a home as well.
Right. You're making such a good point that the problem is that there is an extreme lack of supply. And so as a result, what we're starting to see now, like in markets like Greenwich, is you're starting to see sales activity fall fairly sharply. And it's not because demand has eased, it's because inventory has literally collapsed, where we're seeing, in Greenwich itself, we're seeing inventory levels, down dramatically, at decade lows and even further. And so what that will result in is a lower level of transactional activity, which then makes it harder. But in the moment, meaning right now, to use, another personal sort of story is one of my sons is, just put their home on the market this week in Connecticut, and there are 8 listings in the whole city. And they got about 25 walkthroughs, people walking through within 24 hours, and they got bids that were 25% above a price that they set that was 20% higher than what they thought it was worth. So we're entering in a period where pricing is far more difficult than it was, say, 6 months ago, when there was a flood of activity in the region, and there was a lot of inventory that had built up during the pandemic that is slowly being burned off. In markets like Manhattan, inventory right now, one of the advantages Manhattan as a city has over the surrounding suburbs and many markets in the country is that it actually inventory, because it was late to the party, about 9 months behind everybody else because of the pandemic, inventory in Manhattan is only about 5 or 7% below long-term norms. There's actually product to look at. In the suburbs, that's not the story.
I'm curious also about the buyers who are out there. What do we know about the different groups of buyers and how price sensitive or perhaps insensitive they are? Do you see us getting to a point in the next year or so where we might reach a buyer strike, where people say, you know what, the prices are too high, I can't do this anymore, and just sit out?
Yeah, I think, and there's a saying, I don't know where I got it from, but it's, one of the best solutions or one of the best things for high housing prices are high housing prices. Because what you have is you have a market that we don't have financial engineering of the bubble. We have conservative underwriting from banks for the most part. And so we're not looking at sort of an orchestrated, this is actually, credit quality is extremely high, and people reach a threshold and they're not going to necessarily get variances, allowances from lenders, and they won't be able to, and that will check sort of runaway housing prices. And I think 2022 is going to be a period of rising prices, but probably not at the same level as the last half of 2021. And a lot of that is because of lending standards are still relatively tight.
Jonathan, thank you so much. A lot to think about, and I think Maddie is going to be looking at rental apartments, with a very, very skeptical eye for a while now. President and CEO of Miller Samuel, thank you so much.